the data on apartment rents in the multifamily markets for April of 2026. Now, this is my favorite time of the month. It's these 2 weeks where we get all the crucial data from all the best data sources. We had a little preview last week from Apartment List, and today we've got reports from RealPage, Yardi Matrix, and CoStar. I'm lumping in Apartment List there because we've just got this excellent 360-degree view of apartment fundamentals, and I can't wait to say a lot of numbers and very excitedly, like Harry Enton in CNN. I can't get to that level, but I'm going to try very hard to make these numbers look really exciting. Okay, to talk about actual like themes, common themes throughout, really the theme here was the palpable lull in rent growth, especially in a month that should be a time when rent growth trends higher. So here's some numbers. So we'll start with national rent growth. Apartment List, negative 1.7% year over year, 0.5% month over month rent growth. CoStar has a 0.5% year over year and 0.2% month over month rent growth. Yardi Matrix has negative 0.2 year over year rent growth and 0.2% month over month rent growth. And finally, RealPage, we've got negative 0.4% year over year rent growth and 0.5% monthly rent growth. The average for all of this is negative 0.45% year over year, which is down slightly from negative 0.42%. And that's the year over year number. So a little bit down year over year. Month over month, we're at 0.3%, 0.35% average, which is up a little bit. So yeah, it's a little bit of a wash. Again, it's like a lull in rent growth. It's not necessarily like dipping down or like falling or really scary. It is just like disappointingly stable.
And Matt, it would be irresponsible to extrapolate the month over month rent out forward, correct? Because of seasonality.
Yes, exactly. Yeah. And those month over month numbers too they should be higher now anyways. You can't just multiply that 0.5% monthly over the whole 12 and think that we're going to get like 6% rent growth at the end of the year. But that's but it is at least promising that we've got positive rent growth in some of these data sources. And for occupancy numbers, actually a little bit more positive in general. If you're lumping in them all together, Apartment List, we talked about this last week. It scored their first improvement in occupancy in years, actually. So that's a real big milestone, I think. RealPage also recorded improving occupancy at 95.2. CoStar 91.4. Apartment List again was 92.6, and Yardi Matrix 94.2. Average them all up, we have 93.35 is our occupancy for all these data sources, which is just up ever so slightly from 93.325%. So again, a tiny bit of improvement in occupancy, tiny bit of improvement in monthly rent growth, but we're still down for yearly rent growth. So okay, summatively, why is this all happening? Well, not all of the reports go into it very deeply. I love it when they do because it's like, all right, it's a little extra effort. You're putting yourself out there and explaining why. CoStar for their effort, they cite a still impactful inventory overhang, and they say the quote is, "Supply conditions and more measured demand growth continue to restrain pricing momentum nationally." Measured demand growth. We don't get any deeper than that, but I'll take it. They're doing something there. and I will note too, so for some of these reports, it's difficult for them to say, hey, things are going worse than we thought. I think CoStar is one of those sources where they don't necessarily want to say that it's going too badly. Apartment List has no problem doing that because part of their audience, I think Apartment List, is the renters as well as the investors. And that's fine. Like, I always have to catch myself every time I'm talking about good rent growth. Yeah, it's not necessarily great for renters. Mm-hmm. So that's a little bit of kind of colors the way that these sources will characterize how rent growth is going. Mm-hmm. RealPage notes the regional differences in apartment performance, and more on that in a moment, and gives us a little explanation of why demand might be down in some areas, especially in tourism-driven economies, which is interesting because they talk about a pullback in discretionary consumer spending on travel and leisure.
Because gas is now $5.
Yeah, gas is, you can't even go there. Your day trip now you're like going to the other side of the neighborhood, and it's a bike trip.
That's right. You're using a bike.
Yeah. So they also, I'll highlight that they mentioned the broader economic uncertainty as a theme that we've been seeing in recent months. months. But honestly, I'm really beginning to wonder if this economy ever really was certain. I'm beginning to forget, like, this is the new normal, as cliche as that sounds. I think it's worth getting used to. And honestly, I think a lot of apartment operators are getting used to it. Another theme in this, and it was a theme specifically in Yardi Matrix, which I'll talk about in a second, was focus on occupancy, retention. I'm skipping ahead a little bit. So there was also earning calls for the major REITs recently, and a theme that they were saying is they're shifting from occupancy and retention to rent growth. I think that when they are talking up their own book, and I just think that that's also a little bit more optimistic. Just like Apartment List is catering to the renters and the investors a little bit. Guess who's catering to the investors?
Right.
It's the it's the REITs. But so that being said, I still think people are in a little bit of a hunkered down mode. Maybe later in the year we'll see some positive rent growth, but it's not. None of the reports are saying like, hey, let's get really optimistic. In the year to come. Yardi Matrix, again, like I mentioned, they call out these uncertain economic conditions, and they talk about how consumer confidence is down. Interestingly, they do argue though that there's maybe an opportunity for investors to scoop up some properties in oversupplied markets. Maybe a little distress play. That's kind of like when marketing people talk about SEO play, which is like easier said than done. I did mention Apartment List. They talk about how the time of year is really important context, like you mentioned. In the before times that I'm almost forgetting, apartment growth used to peak in May, and now it peaks in March. Now, it's the suggestion here, or the implication in Apartment List is like this is going to continue. I think that this trend, yes, it was in Apartment List's data, but that may be only the effect of the oversupply. We haven't seen that seasonality weirdness outside of this generation high of oversupply. So I'm maybe a little bit more confident that we'll see stronger rent growth as the year progresses, particularly in maybe not nationwide, but like in regions that don't have that supply overhang. So maybe the 2 months early seasonality will be eroding. I just think that it's no coincidence that seasonality coincided with the jump up in supply. I think that coinciding may be a causal correlation of correction. So yeah, cool. I'm keeping that in.
Stats.
I just liked all those C words that I wrote. That was very fun for me. But yes, I mentioned regionality, and I like teased it a little. What are the hot spots and cold spots in the rent growth map? Well, I will switch to Apartment List. Apartment List has a really nice map that we can kind of visualize where the warmth is in the Midwest and a little bit of the Northeast, and really all of the cooler markets are in kind of the West and the Southeast, the Sun Belt. It has not changed this dynamic that we've seen for several months, if not years. Midwest, again, for RealPage, still in the top of their top half of all their rent growth markets. But I will call out the very top, the tip top of this list is San Francisco and San Jose. San Francisco is filling up all their apartments with AI bros and probably robots. But San Jose has had a healthy rent growth for some time, and it has been more endurant and more looking like really kind of like a more successful version of a Midwestern market in terms of being able to kind of weather the storm that everyone else has, suffered from.
Well, when you scare all the developers from building new units, this is what happens.
Yeah. And that's a good point too. San Francisco, the conversation should also be like, if we're talking about housing affordability, man, it is so tough to build there, and it's because of that kind of lingering NIMBYism. And I think that was really interesting how San Francisco, it was down in the dumps. Even when everything was high, all the rents were high, San Francisco rent growth was low, and it was super low, and it was almost like this is never going to recover. What's happening here? And then the fact that it has only in the past year and a half has San Francisco really shot up. And now in Apartment List's numbers, it is here. Let's show this. Apartment List's numbers has San Francisco at 5.1%. And and I would argue that it could be even higher, but it's really rocketed up there in the past like year and a half. Moving to Yardi Matrix, Yardi Matrix has a great list of monthly rent growth on a bunch of different markets as well, and we can see if these Sunbelt markets are catching up. We see Nashville's up there, and Phoenix, Miami, and Raleigh are all in positive territory, kind of exceeding the national average for monthly rent growth, but not much. It's still anybody's race, folks. That's a little bit of Kentucky Derby voice. There's no clear breakaway market in the South that would let someone say, okay, now we've got the apartment comeback in the Sun Belt. But I know that they will. Of course they will. It's because, Dan, and I didn't put this in the notes, there are large moneyed interests that are interested in boosting the confidence of Sun Belt real estate. And maybe I'll leave it at that. But they're just investors, just like us.
Yeah.
So I'd like to think of us as large moneyed interests.
There you go. There you go.
So I'm going to talk up Midwest, and that's fine. And these next two articles are on the Midwest in an indirect way, and I'm going to biasedly promote our own region that we love.
Of course.
These two are from RealPage, and they're about concessions and apartment supply. And I couldn't resist discussing these reports because they so clearly illustrate these regional differences that we're seeing and will continue to see in the apartment market. I was joking that I am a biased, large money backer of the Midwest, but I only am because it's just so frustrating to see such a clear difference. We've gone over how these Midwestern markets as a region are performing so much better, and they have for months, and yet we get the barest of paragraphs, a small mention in any any like report or anything that you're reading or any podcast you're listening to. They are going to work their way around the performance of all the entire country, and then they will finally spiral into Midwest. You'll get a couple sentences.
Yeah, they'll say it's still stable.
Yeah.
And
And then Midwest, it's doing great. So let's scroll to the end just for some proof here. Let's scroll to the end of these of one of these reports here on apartment supply specifically. They talk about let's see, the Midwest saw starts decrease compared to the previous month. Midwest is also down, so they don't really say it that much. They're not as clear cut in their endorsement of the Midwest as much as there would be if Atlanta and and Charlotte were doing really well. You would hear we would get like 3 different articles for them, but maybe that's me. I'm exaggerating. I'm exaggerating there. That's fine.
I'm glad.
It is true. Like, it is a double-edged sword. We get to find good cash flowing properties, but maybe there'd be a little bit of appreciation and competition and for our investments if we got more attention there. So yeah, I do agree. It makes our job a little bit easier. But to the meat of these articles, they do talk about concessions where they are lowering or they're steady or increasing concessions nationwide on average. So this article on concessions, they say it persists. Elevated concession activity persists across the U.S. apartment market. Well, would you look at that? Oh, let me just scroll down here and see what they say. Oh, wow. Actually, no. The Midwest trailed with the lowest concession usage of 10.2%, a slight decline from February. So they are up across the U.S., except for the Midwest, which we don't count, I guess. So let's move on here to apartment supply. And I'm picking on RealPage. I'm sorry. You've got starts down by a lot in the Midwest, by 30.4%. And they're down by a tiny bit in the West. But the headline on this is that multifamily starts increase in March. Yes, they increased nationwide, but that is because the average is pulled up by so much of an increase in the South, where starts are up 39.1%, and in the Northeast, starts are up by 24.9%. So that moves the average into positive territory. And starts actually were down by 7.3% in the West. So it really is a story of like the South and the Northeast that are pushing these starts up. And this is why it frustrates me a little bit, is because given that the Midwest has higher rent growth now, and the Midwest supply growth was not as strong as the South in recent years, these lower starts numbers point to continued stability. And it's almost like antithetical to you would think that if rent growth is strong and stable, that developers would move in there and build more housing. Well, no, they're moving in building more housing in places where it may already be, quote unquote, oversupplied. And that may mean that rents are suppressed or dampened even more in the South, or at least it's going to lengthen the speed of the recovery.
Or keep that trend of oversupply, consistently going. So
I agree. And I think so, because this is a multifamily investment podcast, this is where I will suggest, I'll look at the camera here, where I would suggest that the Midwest be a great place to look for multifamily apartment investments. I had a little gravelly voice there. I'm trying to perform a little bit.
Doing great.
Yeah. All right.